Okay, well, welcome everyone to our YouTube Live. Thank you for joining us. And it's nice to see some familiar faces here. So, Chestad, great to see you. Volkswagen, very, I like it. And nice to see you, Andrew O'Connell and Peter Ricketts. And Teddy's just joined me here. Hi, Ramin. What do you think of the remaining Vanguard active funds? So we'll launch into the questions in a minute. So usual format, we'll be here for an hour. So as usual, like us, it helps us if you like the stream. And if you do like it, then obviously the algorithm likes us. And we'll just work through the questions. If we see somebody's one of our supporters, we will answer their question first. So don't be offended by that if you see that happen. Or if it's a super chat, yeah, we'll get you pushed to the front of the queue. Unfortunately, you have to pay for that, but that's the benefit of paying, which is we'll answer your question straight away. And then we'll go back to the questions from other people. So let's start off with some questions. Yes, you'll notice that Teddy's on the wall behind me. The reason why is that people can vote on Twitter where, what picture we're going to have. And Teddy won by far, I've got to say. He beat Muttley, he beat Scooby-Doo and Snoopy in order to get that pride of place on the wall. So well done, Teddy. That's very good. Yeah. So there we go. So let's get started on the questions. Oh, and we've already got one from a member. Two of the members say, Arsenio says Teddy is lovely. Absolutely. And Gary says Teddy looks great. Thank you, Gary, on behalf of Ted. So first question from Arsenio. He says, hey Ramin, what a valuable channel you have. Thank you. My question is, why did it go from research in biophysics into finance? And how did you start learning the subject at first? Yeah, it's a weird story. Okay, so let me just tell you how I got into this. It's a little bit odd, I suppose, a bit of a strange path. So my PhD was in biophysics, and I studied anesthetic mechanisms, so the molecular targets for anesthesia. And then I wanted to study how brains work because I got interested in neural networks. So I went to study language acquisition at Oxford University in the Department of Experimental Psychology there. And I spent 2 years working on that, and I published various papers about it. And that was really interesting. And then I went into modeling human behavior for a company that was trying to work in banking. So they were trying to predict what customers would do. So we used something called Bayesian statistics to forecast what likely consumer behavior would be for the customers of banks. So that got me into the whole kind of modeling thing and also the financial thing. And then I decided that working for an investment bank might be a good thing. So I worked for a couple of investment banks, and that's how I got into finance because I needed the money. I was getting married, and investment banking paid very well. And what surprised me was that investment banking was really interesting. I thought it would just be really boring stuff, but in fact it wasn't. And I just worked with some super clever people at the bank. A lot of them were quants. So I was part of a quant team. We were building software as a risk system for our clients, the clients of the bank. So that's how I learned about finance. And it was all by talking to people. I learned a lot of what I did from the people in the pub. A pub is a great way to learn, as long as you're not too drunk. There's a certain threshold. But below that threshold, you can learn a lot. So I learned a lot about investment that way. And that's how I wrote my book. I wrote a book called The Financial Bestiary based on what I learned, not just in the pub, but while I was working at the bank in investment banking. So that's how I got into it. And then I got kind of poached into a team that was doing strategy, so cross-asset strategy. So we were publishing research which was given to fund managers on asset allocation. So I had to learn about all the different asset types that the bank was using. I was teaching at the investment bank for, I think it was about 2 years, where I had to teach clients, I had to teach people at the bank about all of the products that we produced, all the structured products, the derivatives, the FX products, everything. So I knew almost everything about the products that we produced inside and out because I taught the trading and salespeople about it. And then I went off to do the strategy role where I was teaching clients and I was teaching, I was writing research for clients. So that's how I got into it. And then while I was in that research role, I got on TV quite a bit. I was on CNBC and Bloomberg. And then once I left the investment bank, I set up PensionCraft because I realized that people didn't understand much about investing. So that's how I got to where I am today. That's a very convoluted journey, which got me here. Next question. In Slack from Hisham Daoudi, who says, now Hisham, it turns out, I had a really good power hour with one of the clients recently from Holland, and Hisham and that client sit and watch popcorn and watch these videos. So I'm sorry about that, Hisham, because Game of Thrones is finished and this was the substitute, if you can believe it. So Hisham's question is, would it be better to keep my new monthly savings in cash or put it in my diversified bond fund? It's down 3%. P.S. I have enough stocks at the moment. So clearly you do have some exposure to equity, which is good. Now I suspect, Hisham, that you're young because your friend who I spoke to is also young, in which case having a large equity allocation makes sense because you can just see through the volatility and equity will give you a better return over the long term. But your question is really one about duration because cash is zero duration bonds. So the question is, are you better having zero duration bonds which are diversified or cash? And I guess if you have cash, it's going to be in euros because I guess you're based in Europe. And if you have a diversified bond fund, there you do have duration risk, but it's split amongst multiple regions. The US will be a big part of it because the US is a big bond market, just as it's a big equity market. So why wouldn't you put it into bonds? Well, if you think interest rates are going to carry on increasing, primarily in the US, notice in Europe they haven't increased much yet, but in the US, in the UK, they've increased quite a bit. And if you had long duration, you'd have lost a lot. So the question you have to ask yourself is, will they carry on increasing? And if they do, how much? Now, in a video I did recently, I tried to look back in time to see if GDP increases quite a bit to around 4% in the US, 4.1%, something like that, then what would happen to interest rates? And interest rates would actually increase quite significantly if the Fed also comes off the zero bound, if the Fed starts to raise rates. So if there's a combination of the Fed raising rates and growth starts to surprise on the upside, which is now looking quite likely because of what the fiscal stimulus is going to do, then it could be that the yields do rise significantly, in which case you would want to keep it in very short duration instruments. Now, growth in Europe, in particular in the Eurozone, hasn't picked up really, and they're still quite hard hit by the pandemic. So I suspect what will happen is yields will stay lower in Europe for some time. So if you are exposed to European bonds, I suspect there'll be less of a sell-off. But eventually, I guess, Europe will also see an improvement in economic conditions as things improve after the pandemic passes, and then we'll see rates increase in Europe as well. But perhaps not as much as in the US. In fact, far less than the US. So if you think that that's true, if you think interest rates will increase, then yeah, cash would be the better option. Zero duration would be the better option, and that would be better. Yeah. But really depends on your view. And the point I always make is I don't try and tell people what to think. I just tell you what I think's likely, and then hopefully you can make your own judgments, and hopefully you'll disagree with me. I don't want you to agree with me. I want you to understand how to make your own judgments. So hopefully that helps you think about what drives growth and whether whether rates are going to increase, and then what to do about it as a consequence, which is ultimately a decision about duration. Okay, so please like us, please like this stream, it helps us a lot. So let's just see how many people we've got now. We've got 230 viewers and 71 likes. So only 1 in 3 of you at the moment have liked us. So please do like us. And you can also do that after, if you're watching this as a replay, you can still like the stream. So please do like it. It helps us a lot. The last question from our supporters is from Gary, who says, what are total return swaps? Is this Archegos capital fiasco just a one-off, or might there be other skeletons in the closet? Yeah, if you aren't familiar with the Archegos fiasco, let me share my screen so that you can just see this. There have been lots of stories about this recently, but the idea is that well, let me just give you a little bit of background on what it means, and also about wealth management, because I think that's kind of interesting. Here we go. So let's take a look at Robin Wigglesworth's article. Robin's brilliant, so I like his articles. But the idea is that, let me just share my screen. Am I sharing? I don't think I am. Right. There we go. I'm sharing now. And there's Teddy. So this is the article by Robin Wigglesworth. And the idea is that Archegos Capital was a company, well, effectively a kind of company which is run to run the money or to invest the wealth of this chap, who's Bill Hwang. Now, what had happened previously was that Bill Hwang was in trouble with regulators because of insider dealing. There are allegations that he'd done insider dealing, but he was a very wealthy individual. So when you're very wealthy, you can get wealth managers to invest your money on your behalf. And it's very profitable for them to do that. They usually take a fee of around 0.7%. And if you've got billions and you're taking 0.7% every year of billions, that can be very profitable. So the risk department at these banks didn't want to give him too much leeway to have lots of leverage. But what happened was he got multiple brokers. So multiple investment banks were his wealth managers. And effectively, Archegos Capital was a hedge fund. Now, a hedge fund has something called a prime broker. And it's kind of like your version of Robin Hood. So if you're a hedge fund, your version of Robin Hood is a prime broker. Now, if you own lots of derivatives, so call options, effectively you're multiplying the returns on the assets which you buy. But that multiplies your risk. If the values of the underlying assets increase, that multiplies your gains. But if the opposite happens, if the asset prices fall, then it multiplies your losses. And unfortunately, that's what happened with some of the funds which were owned by some of the assets which were owned by Archegos Capital. And then when the prices fell, they decided that they wanted the company to post more collateral, and then ultimately it was decided that the losses were so large that they wanted to wind up the hedge fund. And if they had to sell the assets of the hedge fund, it was a fire sale, which meant that they had to sell these things very quickly, the actual ownership, the stocks which were owned by the fund. And because he had multiple brokers, some of the brokers got out fast. They managed to unwind the assets very quickly, but other prime brokers didn't. So Goldman got out fast, and Credit Suisse, Nomura didn't get out quickly enough. And consequently, they made a loss on some of these assets, because they were acting as prime broker for Archegos. So I think what this really shows is if you do have multiple prime brokers, the individual banks don't seem to talk to each other. The risk departments don't talk to each other. So that was the first problem. So one person I've heard it described as, the risk departments could feel different parts of this Archegos elephant in terms of risk. So one could feel one leg one could feel the other leg, one could feel a tail, but none of them had the whole picture about risk because of the fact they didn't integrate their risk systems. I think the other problem is that each of the banks was simply giving him too much leverage. That shows that the risk department was thinking more about profits and less about controlling their counterparty risk. Now, usually prime brokers are super careful. They monitor the positions of a hedge fund on a daily basis. And if they get, if the losses get too large, they ask them to post more collateral. And this is done on a daily basis. But presumably asset prices move too quickly and they didn't manage to de-risk quickly enough. So, yeah, I think there are lots of lessons to be learnt about risk from this episode, but whether the changes will be made, who knows? Usually these things, people are reluctant to make changes, but I think the investment banks themselves don't want to repeat this episode because it was so disastrous for their quarterly profits. So yeah, I think that's unlikely to make big changes. But that's what happened, and I think that's going to be the upshot of it, which is probably tighter restrictions. Now, the other point is that will this be a systemic risk? Will this force other prime brokers with other accounts to increase their margin requirements? That's a possibility. And if that does happen, then multiple hedge funds will have to reduce their assets, their risk. They'll have to sell assets simultaneously, and it could cause a sell-off in markets generally. That's usually what happens when there's a big sell-off in one asset. It can cause a kind of cascade effect into other assets. But certainly at the moment, that's not happening. Let me just quickly say. At the moment, it does seem just limited to this fund and the investment banks, which took the big exposures. So at the moment, I wouldn't panic. Everything's fine. But that's what happened. Now, a total return swap is actually interesting to know about because it's part of many ETFs. The idea with the total return swap is that if you want to own something, you don't have to use your own balance sheet, you don't have to actually physically own the asset in order to benefit from that asset. What you can do, if you're a hedge fund, is you can get the bank to buy the asset or to buy a portfolio of assets, and then they pay you the returns as if you owned it. So let's say you buy the S&P 500 as a basket of stocks held by the bank. If you have a total return swap on that basket of stocks, let's say the S&P goes up 1% on a basket of $1 billion, you'd be paid 1% of $1 billion on that day. If the S&P goes down 1%, you'd pay the bank 1% of $1 billion that day. So it's as if you actually owned the stuff, but it's held on the balance sheet of the bank. Why would you do that? Well, because it's secret. The bank doesn't have to tell other people what they own. Whereas if you own the stock, you own large amounts of it, you may have to declare what you possess. So for secrecy, from the point of view of secrecy, it's beneficial. Also from the view of tax, sometimes it's beneficial to hold things in a total return swap. So those are the two reasons why you might want to do that. It's efficient in terms of capital, it keeps the secrecy of what you own as well, and sometimes it's beneficial from the point of view of tax. That's why they do it. And Archegos obviously had total return swaps. That was part of the story. Okay, swig. So let's move on to a question from Moth, who says, would you be concerned about the long-term effects of US government spending other than that it pushes the bond yield and interest rate up? Personally, I'm coming from a US equity buyer perspective. Yeah, I think interest rates going up is not necessarily a bad thing because it's a sign of growth. So the reason why interest rates are increasing and why inflation is increasing is because the economy is healing in the United States. And also the fiscal stimulus will be likely to increase growth. and increase inflation, not necessarily by a huge degree. People are talking about 6% growth in the US in the year ahead, and inflation, who knows? I mean, the Federal Reserve doesn't think it's going to get too high, even though we're going to have a big stimulus. But to be fair, they don't really know, which they'd be the first to admit now. But do I think it's a problem? Not necessarily. Do I think the fiscal stimulus is a good idea? Definitely, because the experience of the previous crisis in 2008 shows that it took over 12 years for unemployment to get back to where it was before the global financial crisis. Because after the initial bailouts in 2008, 2009, President Obama kind of took his foot off the accelerator, or the gas, as you'd say in America. He took his foot off the gas when it came to fiscal stimulus. And then he started talking about paying back the debt, and people started freaking out about inflation, which never happened. And as a result, unemployment stayed high for a very long time. There was huge scarring due to that recession. Now, this time around, it seems as if America's learnt its lesson. They've gone in really hard, really large with their stimulus, and I think it's going to make a big difference. They'll probably pull ahead in terms of global growth relative to the rest of the world. Their stimulus is just much bigger, and I think that's a good thing. Yields will go up, but that's a good thing because that's what's normal, to have higher yields. When it was ultra low, when 10-year yields were at 0.8%, that was just weird, and it caused all sorts of distortions in the market. Lots of bubbles, and so anyway, I think that this is probably a good thing. Yeah, that yields are increasing. In terms of can the US carry on servicing its debt, I did a video for members recently which showed that you could triple interest rates in the US at the moment from where they are now, and the US would still easily be able to service its debt. So it's not going to become a problem because the debt servicing costs are still very low, even though there's more debt out there. And debt to GDP is much higher than it was. So I'm not concerned about, certainly not concerned about a default in the US. That's not going to happen. It's very unlikely. Question from Ratna, who says, what's the best platform to invest with leverage in the UK? Well, so yeah, I'd be careful about leverage because, I mean, obviously Bill Huang and this story with Archegos Capital should be a warning to you, because remember, he had a lot of experience of trading, huge experience. He was a professional trader himself, fund manager, and he still screwed up. And generally, leverage is very unforgiving. So if you're new to investing or you're not a professional investor, I'd really think twice about whether you want leverage in the first place. But if you do want it, one asset which is typically leveraged is property. So if you buy a house with a mortgage, your returns will be levered. Usually house prices increase, so it's not a problem. But as many of us remember from the 1990s, if you were levered, you buy a house, the price falls 10%. Because you're levered, you're in negative equity. You'd actually end up losing more than you put into the property because you only put down a deposit of, say, 10%. And you could lose more than the deposit if you had to sell the house. So just be really careful with leverage. Make sure it's money that you can afford to lose, even if the market moves against you. But if you do want to get leverage, another way to do it is via levered ETFs. So you can get 2 times, 3 times the return on the S&P 500, for example. There are many of these 2 times, 3 times levered funds which are out there, but be really careful about whether you want to do that. I'd keep away from it. I mean, if you want to have a power hour with me to discuss it, I'd love to do that because I can tell you what could go wrong, but also what could go right. Sometimes it can increase your returns, but just be careful. Okay, Andrew O'Connell says he's confused about ETFs. My ISA provider caps platform fee at £45 for ETFs. Is that Hargreaves Lansdown, I wonder? So long term, it looks cheaper to buy funds gradually and then flip to ETFs. Is there anything to watch out for doing this? Well, there's nothing. So ETFs are just another wrapper that you can put around your fund. So let's say we create a fund to track the S&P 500. It makes no difference to our job, really, as fund managers, whether we're tracking the S&P 500 wrapped in an ETF or wrapped in a mutual fund. So there are various names for mutual funds in the UK. One of them is Open-Ended Investment Company, or OEIC, OEIC. Another one is ICVC, an investment company with variable capital. But all of them are the same thing, what they call mutual funds in the US. So the ETFs, the only difference between that and an OEIC is that the ETF has intraday pricing. It trades on just like a stock on the stock market, and minute to minute you can see what the value of that fund is, and you can sell it within seconds, just like a stock. Whereas usually you get end of day pricing for mutual funds. That's the big difference. But the fees are often comparable, and the other difference which you've pointed out is that some platforms, not all of them, charge you a different amount according to whether it's a fund or an ETF. Usually there isn't a massive difference in the fees. Sometimes you get the same fund wrapped in both an ETF and an open-ended investment company. So, but there's nothing really to watch out for other than how much your platform charges you for the two different wrappers. That's about it. Just go for the one which is cheapest. Question from MGB07, who says, my SIP is closing in on the lifetime allowance. Congratulations, by the way. Should I balance my future investments in favour of an ISA plus a standard investment account, or continue paying into my SIP? A question on taxation. Well, look, the ISA will not affect your lifetime allowance. So if you are going to invest more, it certainly makes sense to put more into your ISA. The SIP is a pension, so obviously that does affect your lifetime allowance. So clearly, if you are going to hit that limit, then you'd want to move money into the ISA, because there it will be protected from tax, and it doesn't affect your lifetime allowance with your pension. So yeah, I think that would make sense. But generally, if you've maxed out your SIP, then and your pensions, it makes absolute sense to put as much as you can into your ISA. Why pay tax on the money you invest? Otherwise, makes no sense to do that. Moth says, quick follow-up. It seems Chairman Powell has signalled that he'll adjust monetary policy after inflation has exceeded target. Could inflation push 3 or 3.5, say, given monetary policy lag? Thank you. So the central case from the Fed at the moment, if you read their forecast for inflation, is that it's going to run a little bit hot. So it's going to go above 2% for a while in Q2. The reason for that is inflation is a year-on-year number. So because prices were so weak a year ago, because of the lockdowns in March 2020, compared to that base, which is very low, something called a base effect, inflation will look higher than 2% briefly. So just maybe 1 or 2 quarters of that. And Teddy's looking for his treats right now. He's having a good sniff. Or is it inflation you're worried about, Ted? But then it's going to come back down to that 2% level. And what Powell's actually said is that inflation, they'll only act on inflation rising if it averages much above 2%. So if it's moderately above 2%, they won't do anything. That's the big difference in Fed's reaction, the Fed's reaction function, they call it. So they will let inflation run a little bit hot if it's moderately above 2% for some period of time. So that on average, it's around their 2% target, because it's been below 2% for a while. So Yeah, I think what's likely to happen is that if the Fed's right, that they won't raise rates for some time. Probably not until 2022, maybe 2023. It really depends whether this fiscal stimulus, which Biden's announced, which he was talking about last night on YouTube, you can watch it, if that has a big effect on inflation, if it pushes inflation above 2% for some period of time, then yeah, the Fed's going to hike. I think that will be a shock for markets. Even though they're going to signal it, he said they're going to signal it well in advance, I still think it'll be pretty shocking for markets. So I'd just be cautious if that is looking more likely, because markets hate it when rates rise. It doesn't matter how much the Fed signals it, it's usually the cause of a sell-off. So just be aware of that. And it's something to keep your eye on. But could inflation push 3 or 3.5%? Yeah, it's possible, but unlikely, I'd say. But if it does, then yeah, the Fed will do something about it if it stays there for some time. What they don't do is if it's a transitory effect, so something because of a base effect or because of an oil shock, which is exogenous, it's not to do with necessarily the US economy overheating or wages rising, then they won't act. They'll just look through it. But if it does look like a steady increase in prices due to wage inflation in particular, you bet they'll do something. So just keep your eye on not just the inflation rate, but the reasons for inflation to increase. Look at wage inflation, that's really important. Okay.
Night.
Yes. I see that we have 360 viewers now, 368, and about half of you, a bit less than half, have said you like it. So please do like the stream, it helps us. And yeah, so please like it, and even if you're watching it in replay. So next question is from Helder Jose Silva, who says Vanguard FTSE Global All Cap Fund, Index Fund. Okay, accumulation and Vanguard Global Bond Index Fund. Any thoughts on investing on these two funds long term? Yeah, those two are good ones. FTSE Global All Cap will give you global equity exposure, diversified global equity exposure. So that's a good one. The Global Bond Index Fund, again, gives you global bond exposure, diversified across different regions, dominated by the US, but that's true of any market. So I think those are quite reasonable choices. Because I actually made a video called how to create a two-fund portfolio, where instead of just having a life strategy fund, instead of that, the next level of complexity is to have a global equity fund, like the one you mentioned, or a global bond fund and a global bond fund. And then your asset allocation is just how much you have of each. So if you want 60% equity, 40% bonds, then you go for 60% of that fund, the global all cap, 40% of the global bond fund. So it makes asset allocation really simple. And rebalancing is literally a case of selling the one that's gone up and buying the one that's gone down. So it becomes really easy to rebalance. Now you've chosen global all cap. That includes emerging markets, which is good, I think. If you are going to be investing over the long term, it's best to include countries like China, where growth may be higher slightly. And it'll also include fairly small cap companies, not a lot of them because it's market cap weighted, but it will include mid caps and some small caps. So that's what all cap means. And if we're coming out of a recession, as we kind of are now globally, small caps tend to do well. So that might be a good choice. But it is diversified, it's simple. I like that choice. Yeah. There's a super chat from Julian Schmal. Thank you very much. Was there a question that went with it? Oh, yes, the opinion. The opinion on Alibaba shares. Do you consider the VIE structure and delisting risk to be material? Is Alibaba a viable long-term investment? Yeah, I guess. Now, I mean, if you watch our stuff a lot, you'll know that I never invest in single stocks, never, or very seldom, only for a bit of fun, okay? But would I invest in an emerging market single stock? Probably not. And it's for the reason you mentioned, which is I think one of the problems with Chinese stocks is that it is an emerging market. It's not completely, it's capitalism, but not as we know it. So the CEO of a company can disappear for some period of time, and that would not happen in developed markets. As annoying as Elon Musk is, the men in black don't cart him away when he makes a ridiculous comment. Perhaps they should, but they don't. Whereas in China, that does happen. Jack Ma went missing for some period of time, just before the flotation of Ant. So my concern would always be about that kind of emerging market risk. And as you say, if the US decides to delist some of the ADRs, which is when a Chinese company lists stocks on the US stock exchange, if they somehow decide that that's a bad idea, which is actually looking quite likely at the moment, that could really hurt the shares of Alibaba. So personally, I wouldn't buy it. I mean, you can get diversified exposure to Chinese equity via trackers nowadays. There are even MSCI A-share trackers, which is a domestic market. And I made a whole video about that. If you want to look it up, just Google PensionCraft Chinese equity or PensionCraft Chinese shares, and you'll find the video. But single stocks, probably not, and particularly not in emerging markets. But would I buy emerging market equity or Chinese equity via an index tracker long term? Certainly, yeah, I would, because there's less idiosyncratic risk for each of the individual stocks, which would worry me about Alibaba. One Hiccup says, any thoughts on the ITPM courses? Anton Kreil. I've absolutely no idea. I've never heard of ITPM courses, so I couldn't comment. Let's just have a quick Google and just see if I can say anything about that. Institute of Trading and Portfolio Management. Okay. Oh, it looks interesting. Yeah, I mean, it's very different from these courses where they teach you about FX trading, which generally I avoid like the plague. This one looks like they teach you about capital structure. That sounds good. Bond maths. I love that. I love a bit of bond maths, me. And macroeconomic carnage, profiting from it. Yeah, that looks great. It's quite interesting. So it really depends on the price, but yeah, I think that it looks interesting. I think some of these courses which you can see are really just kind of quite dodgy, so I just avoid them. But those look legit. You know, they look quite interesting. Okay, let me just go back to the questions. Right. Andrew O'Connell says, it looks like ARK is having an uncomfortable influence on shares. I noticed the recent fall of ARK K is replicated on Shopify. This must be bad news. Funds with significant exposure a la Bailey Gifford. Yeah, I think that's one of the points I made in a recent video about ARK, is that if you've got a very big fund buying very small stocks, that's great, because let's imagine that typically the stock trades, I don't know, $1 million in a day. But then a massive fund like ARK comes along and buys a big chunk of the stock. If they buy $5 million worth of the stock, that's 5 times the normal market size it trades, and that would push up the price of the stock a lot. So small illiquid stocks have a bigger effect on their price for a given amount of trading, a given volume of trading. So when someone with a large amount of money buys those stocks, it pushes up their price a lot. Conversely, if people are pulling their money out of ARK funds, so if they have big redemptions, at some point they're going to have to sell the smaller stock. They can move the money around a little bit. They can sell the large caps first, where there's a smaller price impact, but eventually they're going to have to sell some of the small caps. And when they do that, there'll be a disproportionately large negative effect on the price of those funds. So that was the point I made in the video, and I actually identified some of the smaller stocks which might be affected. So I didn't realize Shopify was one of them, but yeah, I think that is an issue. And that's one of the reasons why I think ARK might be a destabilizing force in markets, because they don't take much risk control at all, as far as I can tell. They don't avoid having a huge concentrated position in fairly small illiquid stocks. And as they get bigger and bigger, the effect of that will get larger. So at a certain point, they're going to have to either stop buying the smaller stocks and reduce their potential growth, which they'll be reluctant to do, but they will probably have to do that because they just won't be able to buy the small stuff because it's just too illiquid. But that worries me, because if there is a big market sell-off, then it kind of amplifies the sell-off, which is not a good thing for anyone involved. But ARK just isn't very careful about risk control. I think that's the long and the short of it. Right, so I'll move back to the questions, and we've kind of done all of the questions for the people who are supporters, and for the people who've done a super chat. So yeah, let's go back and find some questions. Okay, so there's a question here from Success from Chess, who says, what are some differences between shares you purchase in one country's stock market versus another? Any significant ones? I guess what you're talking about is buying foreign stocks. So if you're based in the UK, for example, it is possible to buy stocks on the New York Stock Exchange, NYSE. What's the difference? Well, one obvious difference is currency. So obviously you're taking the currency risk. If you're a sterling investor and you buy US stocks, then if sterling weakens, that's good for you. But if sterling strengthens versus the dollar, that's bad for you. So that's a risk you're taking, which you wouldn't take if you bought sterling denominated stocks on the UK Stock Exchange. That's the big difference. That's one of them. I guess it might incur taxes, so withholding taxes sometimes. So if your country, so this always depends on which country you're from and which country you're trading with, but depending on those countries, you might have to pay withholding tax if the stock pays a dividend, which means that you don't get as much of the dividend. Whereas if you hold it via a total return swap in an ETF, a synthetic ETF, the withholding tax can be zero. So just be aware of those two differences. But otherwise, it is possible to do. It didn't used to be, but it is now. And many of these new platforms let you do that. So a lot of people I've seen do buy foreign stocks like Tesla, which are just much more exciting than stocks that we get in the UK. Let's face it. Right, so next question. Oh, there's a Slack question. Here we go. So we've got 15 minutes to go. Not too late to like us, so you can still press like. And we've got 440 viewers now and 222 likes, about half of you again. So please do like us, it helps us a lot. And the question is from MGB07. I have 10% of my SIP in Amazon stock. Oh, Lord. Okay. Too risky, perhaps. Yeah. Look, as long as you're aware of the risk, and I assume because you're asking this question, you realize it is risky. Well, is Amazon going to have a catastrophe? Probably not, because it is a large cap. If it was a small cap company, if it was a small cap company or it was an emerging market company like Alibaba, then I'd be worried. Amazon, less so, because Amazon is just such a juggernaut of profitability now that it's unlikely that you're going to get poor buying Amazon. So 10%, yeah, kind of okay. Is that a big concentration risk, both in one sector, consumer discretionary? Yes. In a single stock? Yes. In a single country? Yes. So you see my point, which is that there's a lot. I mean, it could be that it pays off, but it could be that it doesn't. Personally, I would never do that. But as long as you're aware of the risks and you realize that stock selection usually doesn't give you extra return, then yeah, you're going into it with your eyes open. Would I do it? No. Is it too risky? In my opinion, yes. So there you go. Right, so back to the questions from everybody else. So we have 13 minutes to go. So I think we've probably got time for about 4 or 5 questions. And let's start off with this one. What's the difference between a cash ISA and a lifetime ISA? Well, a lifetime ISA is a kind of structure where the government effectively lets you, if you're under 40, so I can't have it, they let you put money into a pension or against the purchase of a house. A cash ISA, you can only put literally cash into it, so the returns will be very low, but you don't pay income tax or capital gains tax on either of those structures. One of the other benefits of a lifetime ISA is the government tops up the amount that you. So if you put in money into a lifetime ISA, the government kind of tops it up. And the actual website for the government is really good to explain how these things work. Let me just share my screen so you can see this. It's not often I say that, but the government website's actually really good. This is what it looks like. So if you use it for those two things, you've got to be 18 or over to use a lifetime ISA. But if you put in up to 4,000 each year, that's the cap until you're 50. So that's the amount you can put in. It's not going to put much towards your house unless you do it for many years. But the government adds this 25% bonus up to a maximum of 1,000 per year. So it kind of makes sense if you're under 40 and you're going to be saving for a house anyway. Well, why not do it? Just be careful that if you use it for something which isn't a pension or isn't buying a house, you get a big penalty as a result. So you have to use it for one of these two things. Unless you're terminally ill with less than 12 months to live, that is one of the exceptions. So you kind of get let off for taking the money out in that case. But it's a pretty extreme case, let's face it. Right, so there we go. Back to the questions. Right, so the next question is, interesting. Okay, so Murphy Magic 33 says, hi, are the value or growth variants of exchange traded funds a distraction? VOO, VOOV, VOOG, for example. Am I just better off with VOO? So value and growth. Well, I think the difficulty is that factor funds, the idea is that people have shown that value, for example, outperforms most of the time, or at least it has historically. Recently, growth has done much better. But since February, since interest rates have been going up, which probably isn't a coincidence, growth has underperformed, which is why ARC funds have underperformed and value has outperformed. So if you do go for one of these value funds or growth funds, I think it's really difficult to to know when you're entering a regime when one will outperform or the other will outperform, value or growth. So I think for most people, they simply don't have the discipline to stick with one of these factors, even though it falls. So I think for many people, it's just much easier to buy VOO, for example, a global equity market fund, and just track it. It's simpler. And then you don't get these long periods of underperformance when you have fear of missing out. You get these FOMO feelings. So although I kind of like factor funds, I think the cognitive biases are working strongly against you, and these cognitive biases will probably mean that you don't outperform. So I'd be careful about that. That's why I think it's probably best to stick with VOO, because it's just simpler. But if you feel as if you have strong conviction that growth is going to outperform, then yeah, go for it. But just make sure you stick with it and you don't keep switching between value and growth, as one does better than another, because that's unlikely to do well. Timing is very difficult for those factors. Slack. Oh, okay. So we have 8 minutes and we have a question on Slack. This is from Adrian Cook, who's one of our supporters. Mm-hmm. Thank you, Adrian, for supporting us. And thank you to all the other people who support us on YouTube. We couldn't stay independent without you. So thank you. So Adrian says, what's driving the US dollar upwards currently? And do you think it has room to run higher here? So let's have a quick look at US dollar. Let me share my screen again. Here we go. And we're going to use Fred, trade weighted dollar. Here we go. Now what this is not just the dollar against one currency, but against an entire basket of currencies which it trades mostly with. So when this is going up, it means the dollar's strengthening. When it's going down, then it's weakening. So what are the factors that drive this? Well, a big factor is fear. So if we go back to the sell-off in March, notice how the dollar strengthens. That's because the dollar's a safe haven, and when people are scared, they buy dollars, they sell foreign currencies. But then gradually, as people bought back into equity, the dollar weakened. Also, interest rates in the US and elsewhere were all at zero because all central banks had effectively gone to the lower bound. So there was no interest rate differential and people weren't scared anymore. So the dollar weakened hugely. Now, since then, what's happened is that the US has announced a massive fiscal stimulus, much bigger than everybody else in terms of scale relative to GDP. If that's true, then what we'd expect is for growth to increase in the US more than the rest of the world. And if that happens, that tends to push up long-term interest rates as we're pricing in more growth and inflation. And what goes with that is a strengthening of the dollar. So I think the effect of this fiscal stimulus will be huge. And secondly, it'll be quite long-lasting. So I expect that the dollar will continue strengthening for some period of time while we see the effects of this fiscal stimulus feed through into the economy. And of course, at some point, the Fed will also start to think about increasing interest rates, which will happen before other central banks raise theirs. So both at the short end of the curve and at the long end of the curve, I expect that the US will be higher. And the general effect that has is a strengthening of the dollar. The only thing that would reverse that is maybe if the US doesn't outperform, but I think that's looking decreasingly likely at the moment, or very unlikely, I'd say. So yeah, I think that's going to continue for some time. Is there any other part of your question? Oh, another question. This time from Gary. Gary says, if growth comes back strongly and cost of capital rises, large cap growth stocks will shed their frothy PE multiple. I agree. Given the S&P 500 is dominated by these stocks, return can be muted. Your thoughts? Yeah, I think the rotation we've seen so far. So the S&P hasn't sold off much at all. As interest rates increased, what we saw was a massive rotation under the surface of the stock market from growth stocks to value stocks. And usually it was the smaller growth stocks which got smacked the most. And in fact, that's why almost all of the stocks which ARK likes were those smaller or mid cap, or some of them large cap, but usually mid cap US and elsewhere growth stocks. But what we didn't see was large cap growth get so much of an effect. And that's why the S&P still continued to do well. So the S&P would be affected if those large cap growth stocks start to take a tumble. But we haven't seen that yet. They certainly have slowed down. So the massive increase in the S&P that we saw, all that's really happened is the momentum has kind of come out of the US equity market. But I think if interest rates carry on increasing, then it could be a problem for large caps. And I think if the Fed starts to think about raising interest rates and signaling is going to raise rates and stop its bond purchases, yeah, then it's going to be a real uphill battle for growth stocks. So yeah, and gold. Gold obviously is affected by rates too. So a big regime shift, in other words, if we do see interest rates continue grinding upwards and growth spreading out more widely in the economy. Yeah, so I agree with your thesis, Gary. I think that's quite a likely path forward. So we've got 2 minutes to go, and let's get one more question, and then I'll let you go. Okay. So we've got 476 viewers, 279 likes. So please do like us. It helps us a lot. It helps us with the algorithm. And let's choose this one very carefully.
This one just by, hang on.
Oh, we've got another one.
Moth.
Okay. One more from Moth. There's also an argument that a good portion of investors using the interest discount model have used 3% interest rates instead of whatever lower rates we saw last year. How do you evaluate this? Well, I guess it's always going to be relative. So if you do a discounted cash flow model with 3%, if the 10-year rate drops or rises, you'll always do it as a delta to that 3% or whatever you've used. So I suspect what's happened is that whatever interest rate people were using in their models, it will have increased recently. So that means that the prices of almost any stock are going to look more expensive as interest rates increase. It's very unlikely that you'd ignore an interest rate rise if you use a discounted cash flow model. You just wouldn't ignore it. So whatever your rate that you're using, if the 10-year yield increases, you'd increase your yield. You wouldn't keep it the same. But 3% would surprise me. Most people tend to use the 10-year rate or even shorter. So for example, if you look at Damodaran's models, they use the 10-year treasury rate as a risk-free rate to which they add the risk premium. So that's just what he uses. But yeah, you've just got to choose a tenor for your risk-free rate, and that's a commonly used one. 3% would surprise me though. I think that's probably a little bit too high. Because remember, 10-year rates were at 0.8% just 6 months ago. Now they're at 1.7. So big change. Anyway, I think that's probably where we'll call it a day. Thank you all for joining us. It's been great to have you and having such wonderful questions. And I hope you found it useful. Remember, you can always join our community. So on Patreon, just go to patreon.com/PensionCraft. There'll be a link in this description beneath this video. And you can have a one-to-one power hour with me if you want this face-to-face interaction with just you and I. That's always a possibility. You can book that on our website. Just go to PensionCraft.com and you'll see how to book it. And yeah, hopefully you'll subscribe to our channel, tell your friends about it, and hopefully you'll find our educational content, most of which is free. Hopefully you'll find it useful, and you can now support us directly on YouTube as well. Just click on join underneath this image, and that way you can support our independence. Anyway, it was great to have you all on the call on this live stream. I've been told not to call it a call. That's old-fashioned. And see you in 2 weeks' time. Have a great Easter if you celebrate Easter, and see you in 2 weeks.